Peterson, I'm your Director of Equalization. We have Maggie Printon, who is our Deputy Director of Equalization. And in the courtroom with us today too is also Jeff Putoff, and he is the Property Tax Specialist from Department of Revenue. And Jeff is also the person that does our audits, and he also does our intentions. So I'm just gonna ask that you hold your questions till the end, because chances are your questions are gonna get asked while we're talking. So, unless there's something you just can't wait to ask, please hold those questions off, so. Okay.
Can you hear them with the mic? Go ahead and pull the mic a little bit closer to you there,
I
Tammy.
didn't think anybody couldn't hear me.
There you go. Now everybody can hear you.
Okay. It is our job to determine fair market value. You will hear fair market value over and over and over because that is our job. Our job doesn't have anything to do with taxes. Our job is for value. What is happening with the value at the time? We have three approaches that we have to use. It's cost, market, and income. And we use the cost and market most. And market is always used, but we use the cost and market most. And then we use the income for commercial properties mostly. So, and we don't use that very often. I think in the 22 years I've been here, I used it one time for the nursing home in Lake Preston. Other than that, we've never used that, so. But you will hear again, fair market value, going through this over and over and over, because I can't stress it hard enough, that's our job. So, first one is the cost approach. That is, how are we gonna replace your property? What is the cost to replace it being like it is sitting right today? Replace or reduce the subject property, and then we subtract the depreciation. So, and then we compare it, of course, after that to the market to see where we're at market. We do not go to every single property every single year. We're not able to do that. We have 82 plus 100 parcels. We're in a 10-year rotation, just so you know. And so when we come out to do reappraisal, that's when everything starts over again with the cost. And I'll talk about that a little bit further. And then again, we take the cost approach. Once we do all those numbers and take off the depreciation, then we compare those values to the market. What is happening in the market? The cost approach, they're based, of course, on square footage, amenities, quality and condition at the time of the reappraisal project. So we're doing DeSmit and we're doing Lake Preston this year. You will get a letter in the mail that tells you that we're coming, and it will say either morning or afternoon, but it will give you a date. If you can't be there at that time, please give us a call, because we will leave you, if you're not there, we're gonna leave you a blue ticket on your door telling you to please call us, because we wanna make sure our information is correct for everybody. When we come for reappraisal, we do the value, and how we do it then is we have a Marshall Swift valuation service, and that tells us the value. That by law, we have to use one of two. We could either use Vanguard or we could use Marshall and Swift, and we've always used Marshall and Swift, so we're not switching on that. So when we're done, we go to the house, we look through the house, and the biggest thing we're looking for is condition when we walk in, because if you maybe don't notice it because you've had your house for so long and it's always been this way, maybe when we walk in, we're gonna see all the cracks and we're gonna see the spongy floors. We're gonna feel that as we walk across, and we see that a lot in our older houses. And your value is definitely, a lot of it is on condition. The quality just depends on how many ins and outs you have on the outside, where if you just have a rectangular house and a plain old roof, it's not a very high quality home. Not to say that it's not a nice home, but it's for valuation purposes. We then go the replacement cost new less depreciation. We take the value in the current condition times the market value if one is needed. Now we just did Arlington and we did Iroquois. Both of those, we found out that the homes mostly needed to come down, and that's good. We knew that, and so we knew that had to go, and I'm kind of expecting the same thing to happen both in Lake Preston and in in DeSmit, but we'll see how that goes with the market, because market value plays a big part of it. The cost approach is used for all new construction properties in the county. So we always use that Marshall Swift valuation service to figure out what a new property is gonna be. If you build a new pole shed, if you build a new house, if you build a new commercial building in your town, that's all gets placed against the cost approach. Cost approach and mass appraisal. Like I said, we're not able to visit every single property every single year. So then we break it down to, we figure out what is our, after all the sales, this year we had 376 sales that we had to go through, plus mobile home sales. Try to figure out what's a good sale, what's not a good sale. A good sale is gonna be, it was on the open market. Open market can be a sign. We watch Facebook Market and signs in the yard and land.com, we watch all that. So that's where that's where the cost appraisal comes in for mass appraisal. So let's say now we got done with Iroquois and we're done with Arlington, okay? So now we're not going back there again for another 10 years. So we're gonna do the market analysis in November when we're done with our year, because our year starts November 1st. We're gonna do that and we're gonna say, okay, where is Iroquois, where's Arlington at compared to what the sales are? Because last year, we were really good in both those towns, and so we didn't have to do a big market adjustment. We're gonna see how that's gonna work this year, because we don't know yet, because we don't know what the sales are all gonna be. I know there's one guy at the lake and he said, we got a house across the street and it's for sale for over $1 million. Well, yes it is, but one sale does not equal a market. We like to have anywhere between 10 to 15 so that we can break that down. What we do is, we were at 81% this year for overall non-ag, okay? So now, okay, that's not even legal. 85% is taxing. So we like to keep our values up in the 93 percentile, and then it goes from 93, when it goes to ECHO, it goes from 93% down to 85. Because that's where we tax at, and that's where your job comes in as a board, and that's where your tax part goes. That's the most you're gonna hear from me about taxes, except for the words, you can't abate your taxes. You can't. We don't talk taxes again because we don't do taxes. So, reappraisal is gonna be this year in Lake Preston and DeSmit, and we are asking, even if somebody doesn't feel comfortable with us coming into their home, please call us and let's talk about what's going on with your home. That's the better way. Now, if you're gonna tell us that your house is, oh my gosh, it's just so bad, well then we're gonna ask to go look. Because if the last time we were in there was 10 years ago, and we were actually shown the property, we're gonna wanna see how it went in 10 years from being probably average for its age, down to absolutely no, you just can't live there anymore. We have a lot of that, we get a lot of those kind of phone calls, and we do go out and look, even if it's not reappraisal for your time. I already talked about the blue tags. Mass appraisal using the sales ratio. It's a process of valuing a group of properties as of a given date. And our given date, of course, is November 1st, because that's always our starting date. What we do then is, mass appraisal is the process of valuing a group of properties as a given date and using common data. Standardized methods, which is the Marshall and Swift worksheet, and statistical testing. And then we determine the market to see if the market value has been met. A lot of times it has, a lot of times it hasn't. And so that's where then we have to start dividing out what the markets are. And in Kingsbury County, we have several markets. We have Lake Preston, we have DeSmit, we have Arlington, we have Iroquois. We have the small towns, we have the lake, and we have ag. Those are all the different properties that we're gonna pull out of all the information that we got from the sales. So it's gonna be, okay, we had 15 sales in Lake Preston City. Where did Lake Preston City sit at the time? Lots were very low. We found out lots were low across the whole county, so lots went up. how our house is sitting, cause we can break that out, we can break that out, cause we can see it. When we do the Marshall Swift worksheets, we can see it. And so then we determine the value at that point. Like I said before, we have 8,200 parcels in the county plus. We had 376 sales for November 2025, taxes payable 26. Mobile homes transfer, 76 of these were used for values, and those were split out. Some of the sales went to Lake Preston, DeSmit, Arlington, Iroquois, small towns. That's what our markets are. And that's worked very well in our county. The county, there's a law that says we can only use the county's information for the valuation. We cannot go outside of Kingsbury County. We're not fee appraisers who can do that. They can go out of the county, because if you have a one-on-one, one-on-one, you want a loan, Roger wants to get a loan for his house for $1 million, a fee appraiser comes out, a fee appraiser can go all over the state to try to come up with what his value is gonna be. We can't do that. We have to only use the information that is used in Kingsbury County. We need to publish all of our stuff, and that's on our website. Anytime you can go out to our website and you can see what the sales are. If you have a question and you want them emailed to you, let us know, we'll email them to you, that's not a problem. 4 times a year, we have to send all of our sales information to the state. And that's what our percentages are, where we at with value versus what it's selling for, all of that goes to the state. At the end of the 4, then the Department of Revenue comes out and then they audit us. They take every one of our sales, they go through every one. There's different pages that there is to go through, and they go through every single one, and it's an all-day process, and in some cases, I'm sure it's more than that for day-wise. For us, it's an all-day process. We're looking to see if there's good sales. The good sales that we want are the ones that are on the open market, not a willing buyer and seller. If it's a father selling it to his son for a lot less, they're pretty good about telling us that. We can't use that sale. If it's a private sale where I go up to Roger and I say, Roger, I'd really like to buy your house. What would you have to have for it? It's not on the open market. We can't use that sale. That sale then gets kicked out. Okay. What's that? Yes. Determining which sales are included in the sales ratio. You are going to see up online, this is a sale that happened in Lake Preston City. It was sold by, Commercial. This is a form that we get from the Register of Deeds office. All the pencil marks are ours, okay? Tailored Structures sold it to William Leasy, okay? He sold it for $230,000. We got the verification letter back, because we always send out verifications. We either call you, we always mail you a letter. If you choose not to answer it, we will call you and ask for the information. In this case, it was a good sale because it was on the open market. So this sale was used then in the numbers for Lake Preston. That got put into the pile for Lake Preston City because it was a good sale. All 376 sales are just like this. This comes from the Register of Deeds and it comes to us. After we enter everything and we're all done with everything, we then send it to ECHO. ECHO then does the work with whatever you guys do with boards to come up with the tax. The next page is the certificate of value. This is what comes with the other page that is filled out by the closing agent, whether it's a realtor or a title company, or if it's just Roger signing it over to me. This is what has to be filled out. There's a lot of questions on this. Not all of them are always answered correctly, because nobody cares but us what it says, to be honest. Nobody cares. A lot of the questions are, the biggest one that we don't get correct was this on the open market? They always say yes. Or they always say no, just depends on who you are. They always do that. But this part is we didn't have this one filled out, but this one, is hooked to every single one. Okay? The next page, whoops. The next page is a letter that we send out to the landowner. And this is where they tell us all the information we need to know to find out if that's a good sale or not, and that's the truth. We believe what the people send to us.
Both the buyer and the seller get this exact same form. When we get them back, we compare the answers from both of them to the certificate of value and the other local knowledge that we have.
Okay? And again, verification is crucial. We need to have that verified, because we don't wanna use a sale that shouldn't be used for your value. For your value. It should not be used for that. That's why we wanna know. This is very crucial. We pay close attention to what's on sale, what's for sale and what's not for sale. We get asked quite a little bit, is there anything for sale? Do you know of anything that's for sale? And we do have a running total after driving the county, what we know is probably for sale. And we use Zillow and Facebook Marketplace, auction websites, and a local MLS. And I found a new one yesterday, it's called land.com. I didn't know there was such a one, so, there you go.
Can we go back to the verification letter?
Sure.
Something that's important on here that a lot of people don't necessarily fill out or know or understand, that we get a lot of phone calls on, and it is important, is this question right here: was personal property included below in the purchase price? So if we have, say, a lake sale, and for an extra $5,000, you guys can keep the dock, and we've got a pedal boat or whatever, that's why that's on there. We like to know that, because then that $5,000 is gonna come off the $230,000 that they sold it for. So that's why it's so important when people get these letters that we get them back, because those are private items of the sale we don't know. We just get the dollar amount that comes on the deed when they transfer the property to the other party. So if you know someone who's selling something, or they're getting this, encourage them to fill it out accurately. We've had things, like dock, pedal boat, refrigerator, freezers, furniture, and then we ask them to give a value, so we can take that off the top. So that way we're getting as close to just the real estate as possible. We take all those extra things into consideration, so that way we are as close to market value for just the real estate, not the personal property as well.
Very true. Okay, the verification, we use Zillow. We use realtor.com, Facebook Marketplace, yes, we use all of those. And we keep very close contact on what is for sale in the county. Now the ratio process, that comes each time. We get the ratio, if you go back, maybe, can you go back to the one that showed the sale? Did you write the ratio on that one by chance? Okay, so when this sold, we got to 92.68% of market. That's great. We wanna see them that high. That's good. Very rarely do we get anything up to 100%, but that is good, and that's a good sale to use for the town. And so that's part of what the ratio process is. Then we do a ratio study. We study for each town, and I told you before, we do Lake Preston, Arlington, DeSmet, Iroquois, small towns, Lake, and Ag. Then we do the ratio study. Where are we at? I've got 15 sales in Lake Preston. Where are they at? Where are they at in the market? We do all that math just like we did before, and then it goes on a spreadsheet. And then we array it, where are we at, where's the middle. So if we're only at 86% of market, that's really not a good place to be. It's not a good place to be. We like to keep you up in the 93s, and we've done that pretty much for the whole time I've been here. So our assessments, our notices are prepared and mailed no later than March 1st. Now, for those of you who have boards, and you know that there's appeal times, I always send the finance officer a letter telling them when you need to meet and what is the last day to appeal. If you've got somebody that lives outside of the taxing district. So let's say Corey bought a house in DeSmit, but he's still got his farm. Okay? We need to know where we're gonna put all that, so that's not a big deal. Okay, when I was trying to go with that, so the farm. So now he decides that he doesn't like the value that I have on his land, on his farm. He doesn't have to go to the local board, he can go straight to the county board. But they have to live outside of the taxing entity, if that makes sense. Somebody has a lake house in Sioux Falls, they don't wanna go to Baker Township. They don't have to go to Baker Township, they do have the right then to come before the county and send us a letter. And then I'll bring them before the county and then they can do their appeal. The last thing I'm gonna say, market, taxes are not appealable. You cannot appeal your taxes, and there's so many people that think that you can, and you cannot. And as soon as their tax notice comes out, that's when they notice what the value was. This year, we had a really good turnout for people really looking at the assessment notices, calling us. That was wonderful. We could explain how it all went. Arlington, after we did them, there's a few people that called, that was great. We explained the process to them, and it went very well. So, that's it for my part. Jeff Putoff it will be next, and he is a tax specialist from Department of Revenue. He is the one that does all of our audits. And he's also the one that looks at our intentions to make sure that everybody is treated fairly. So, Jeff, your turn. Watch out for the cord.
Good morning, everyone. I guess
It's still morning for.
still morning by 5 minutes. So, as Tammy said, I am Jeff Putoff. I am with the South Dakota Department of Revenue. I am a property tax specialist. I've been in the field for 13 years now, almost. I started out with the county, Yankton County, as an appraiser, and then the last almost 4 years, I've been with the state as a property tax specialist, field person for 23 counties in the southeastern corner of the state. So, as Tammy said, I do the audits. Today I'm gonna go over the purpose of the ratio studies, say what a sales audit entails, and then we'll get into a little bit about intentions and then the factors. Most of what, or pretty much all of what the directors of equalizations do are dictated by statutes. The purpose of the sale ratio status study is to fulfill a couple statutes. They're the primary tool of measure for mass appraisal performance. It tells you what level of assessment, assessed value to sale price. It measures the fairness and the quality of those assessments as well. The more sales that we can include in the ratio study, the more confidence there can be in valuations. I'm not really gonna read through all these, but basically these two statutes indicate that the assessed value using the ratio study has to be within an 85% or greater. When she does set values each year, she is mandated to be within 85 and 100% when we're talking about that median ratio. So we have our group of good sales, half of them are above the median, half of them are below the median. That median level is what we're looking at. And that number has to be within 85 to 100% of full market value. As a department, we have to compute these numbers. It allows us to monitor the assessment levels, conformities. It provides data to help equalize the taxable values across all counties in the state. we calculate the factor based on what those sales and the changes that they make, each year to market value. We'll get into the sales ratio process now. It basically follows step by step what the counties do when they process a sale. First and foremost, we look at the parcel number. We want to verify that the property transferred is the property they actually are using on the sale. We match up legal descriptions, so we can make sure that the values we're using to determine the ratio is accurate. We wanna make sure it's the correct year of sale. Sometimes that instrument date is prior to the November 1st assessment date, so it gets put in a different year of sale. We wanna make sure we're using current sales. And we have the correct classifications and the correct valuations that were on those properties during the previous assessment. Next, we look to the sale price. The stated consideration on the PT 55 isn't always accurate, as they kinda went over. Sale price can be adjusted for certain types of financing issues, or personal property is the majority of them. If you do have a property that sells with all the furnishings and dock and boat and all that stuff, and it's included in the purchase price there, we wanna make sure that that sale price gets adjusted. So we're only looking at the real estate, because that's the only thing that the assessors can value, is real estate. We do not assess personal property, we do not tax personal property, so therefore we need to make sure that the sale price is only reflective of the real estate. The final determination will be to either reject the sale or include the sale in the sales ratio study. We have rules as to what is included and what's not included. We will only use sales that are an arm's length transaction, meaning it was available to everybody on the market for a specific amount of time. There was no coercion or need to sell. And then we wanna make sure that they can adjust for sale price for certain issues. Again, all this is dictated by statute. The director has to follow statute, we have to follow the statute. We verify this information to make sure that the sales that they are using to value properties are accurate for market values. These are the primary forms that we use for verification. They kind of went over the certificate of value. It includes it's the first level of verification because it must be included with all transactions that transfer property. It contains buyer, seller, legal description. It also notes the actual consideration or adjusted consideration if there is personal property. There's an area on there for the buyer, seller, or agent to note if there was personal property included. It also has a statement whether it was on the open market or if there was a relationship involved. If we're business partners and I'm selling out to my other business partner, there's a relationship there that's not a good sale we want to use to help value properties for everybody in the county. The Director of Equalization also independently verifies, or should, which Kingsbury County always does. We have those letters that are included on every sale. These are what I go through when I am performing the audit. I make sure that the information they have for each sale matches the PT 54, PT 55, comes for the Register of Deeds, so we can make sure that we are only including those good open market arm's length transactions. Every sale is a good sale unless it's proven otherwise. That's why the verification process is very important. There are only certain reasons that that it can be rejected from that. And first and foremost would be not on the open market or not on the market for a long enough period of time. Some of those are ones I'm sure you've heard. In the last 5 years, we've had a lot of sales that don't even hit the market, or they're sold before the sign goes up in the yard. They were never advertised, they were never available to the general public. A lot of times it was somebody approached somebody and wondered if they'd sell, that kind of thing. Those are ones we do not want to include because they're not reflective of what a market value would be current. Changes in use, if it changes in classification, ag to non-ag, splits or a major physical change, if the sale price is reflective of a completed house and the house was not built as of the last assessment date, the ratio then therefore is completely out of whack, because we only had land value on the last assessment, but the sale price was for $400,000. Those sales are excluded because that ratio, it doesn't mean everybody needs to increase value by 500%. Partial interest only, those aren't complete sales, therefore they will not be included. The more sales, as I said, in the ratio study, the more confidence the director can have to identify market trends or identify the necessary changes to make from one year to the next. Once we have decided to include a sale, we then calculate that ratio, which basically tells you the level of assessment. It'll tell you how close to market value the assessment is. And that number we would like to see, like I said, when we're looking at all those sales, we need to have those between the 85 and 100% of full market value. Now that we've gone through every sale in Kingsbury County, we can start analyzing the data. We have all the ones that are marked rejects. We have the complete audited sales list. We may have thrown out some sales that weren't open market. We may have brought some back in once we found new information that they are on the open market. We can extract those good sales only, so we can do our statistical analysis. Every year, once the audit's complete, there's a county statistical report that's generated. This shows how the sales are stratified. You can divide them into in-town, out-of-town, residential, commercial type of sales. It does show agricultural sales, but the main thing we're worried about in the sales ratio study is our non-agricultural sales. Because ag properties are valued by productivity, which is an income model. As the director was stating out, there's 3 different methods to valuation: cost, market, and income. Ag uses income, but we do keep track of those numbers because we want to make sure that that productivity valuation that are going on agricultural properties are not exceeding what the actual market value for those properties are. If this number for the non-agricultural median is below 85, that means the director has some work to do. They're not within statute. They have to get that number, they have to make market adjustments or reappraisal work in order to get that number within compliance to statute. And they have to get that above 85%. The intentions work, after we have done the studies, the director of equalization now can break down their sales. They will look at each area. As she said, there's different market areas that she looks at. She pulls all the sales for that certain area to look at those. When she does stratify the data like that, it can show areas that are need for reappraisal. If their numbers are significantly variation within a certain market area, it could show a need that that area needs to be looked at more closely. Maybe the reappraisal for that area moved up in time on their schedule, so they can get out and equalize those values a little bit more, so hopefully they can tighten up those sales. Sales can show the need to update cost or depreciation tables. It'll identify the market trends and whether they need to increase or decrease in certain areas when they're doing that study. What we receive at the state then is a list of pending year values. We use the original sales to indicate where our beginning level of assessment is, using last year's assessments. And then we get numbers for what the Director of Equalization is going to do after they've studied the market and determine what their changes are needed within certain areas. We see the new values, and that helps us determine what their new level of assessment after changes was, because that's what we have to take into account when we're looking at our statutes that we have to follow. And with the changes this year, this comes directly from Kingsbury County. They started at 81.7, which meant they had to increase at least the median by that 3.3% to meet a minimum of 85. Like Tammy said, she kinda likes to go in the middle, 85 to 100%, 93, it's kind of a bell curve. So we have sales, a lot of sales packed in the median. We wanna make sure that the majority of sales are within that 85 to 100. There's always outliers, that's what the appeal process is for, to kinda settle those out. But the median level, that's what we look at when we're determining factors, which derive, or which gets us down to the taxable value. We review all the documents that are there. Like I said, we wanna make sure that those changes made do get them within statute of between 85 and 100% on the median. We do analyze sales with the director if they need help, but the assessed values are the director's decision. That is their job to set values within the county. The DOR does calculate the factor, which is based on the new level of assessment on the previous intentions form that we showed. The reason we calculate a factor is because, according to South Dakota statute, you are taxed on 85% of market value. So we have to look at what the median level is, and we get everybody equalized, so every county in South Dakota is only taxed on 85% of market value. If we have one county at, actually my next slide shows. If we have one county that they get their assessed value just to the bare minimum, 85%, you are going to be taxed, you're gonna get a factor of 100% because you're gonna be taxed on all of that because they just met that bar of 85. If you get a new assessment that goes to 100%, the factor you will receive is 85% to drop that taxable value down to the 85%. So everybody statewide is taxed at a level of 85. This year, after changes made and reassessments made, Kingsbury County's new assessment level was 93.4, which means their taxable value will be 91% of the assessed values. And that simple formula gets you to 85% of market values. And that is pretty much what I have. We follow the director's workflow when we're doing our process, just to ensure everything's being handled, accounted for, and necessary changes are made to those assessed values.
So, for this year, or for 2025, you said the taxable value is 91% of the assessed value. So the assessed value of that 93.4%, that's what I'm finding on the form that I get in the mail.
That is what we're saying the level of assessment countywide for all non-ag properties is, correct?
So, but the dollar value that's on my assessment it reflects 93.4%.
When we're talking about all the sales that we're using, and it's a statistical analysis, so, what's the number that's on your assessed value, on your assessed form, is supposed to reflect what current market values are. When we look at what all the different values are, because we can have significantly different values depending on the appraiser you bring in, you know, they're
Sure,
not always gonna match up perfectly. We don't live in a perfect world. So we have to use statistics to analyze where are the majority of everybody sitting? And with the assessed values that, after the changes that were made, when we analyzed this, we figured that median number, which is what we have to use to analyze how good of a job the director is doing on getting to that market value. We're saying their median number is coming in at 93.4% of what the full market value would be. But you're only, because it's at 93.4, we have to factor that down, so we're only being taxed on 85%. That's what that factor number of 91%. So your assessment will show one number, your tax bill will show that number and an equalized value.
Okay.
That's the taxable value, that's what the levies are applied to.
alright,
So it's this, for this next year, payable 26, you're gonna see the full and true value, you're going to see the taxable value, which is your full and true times 0.91, or 91%. That is what your levies are applied to, that's what your tax are.
thank you.
Yeah, we have another co-worker from the Department of Revenue on, I believe.
Next, you'll be hearing from Robin Carlson. She's the education specialist for the state, and she also, is really great at TIF districts. If you ever have a question about a TIF, she's the one to talk to. In fact, I talk to her quite often, so. Are you ready, Robin?
Uh-oh.
We can't quite hear you, Rob.
Is that our entrance theme?
Sure.
How is your volume? I'm just kind of randomly speaking to
Okay.
have you guys, give you guys something to gauge. Do you have volume now?
Yes.
Is she gonna share her screen?
Yes, I have a PowerPoint. Can you hear me?
Yes.
Yes.
Okay, good deal. Now, can you see the PowerPoint presentation?
No.
Sorry, it just totally went away. Do you see it now? Are you able to see the PowerPoint slideshow?
No, we can't.
Oh, that's interesting. Do you see me?
I see you in the little screen
Yeah.
now.
Okay, do you by chance have the availability of this, slideshow in front of you? I don't know how else, so I'm sharing my screen, and I'm showing the PowerPoint presentation as being up.
I have the PDF and email.
Technical issues.
Yes. Where's our IT department?
What's that?
Where's the IT department?
Can you try again,
It's,
Robin?
but you still don't see it, is that correct?
Can you try again? We just changed the slide.
Sure, what okay, so now I'm back to seeing you guys, I'm just trying to, get this to, so where you guys can see it.
There's some there.
Is that any better, or should I just, speak?
I get it, I have the PDF that she emailed this morning, that I can just scroll through, but it won't click, she won't have the clicking effect.
And that's okay with me, if you have the ability to just scroll through, I'll just say next, if that works for you,
Okay.
and then we'll go on to the next, slideshow, does that work?
Yeah, just let me get into my email here.
Just tell me when you're ready, and I'll get started. I'll just briefly tell you, I'm Robin Carlson. I'm with the Property Tax Office out of the Pier location, and, have been with Property Tax for 5 years. Basically, my role is to look at all of the values that are submitted from each county office across the state. And basically, those values are used to, establish what the levy will be for each taxing entity, and that's back to the auditor's side. And then, as Tammy said, I work with TIC, and I work with education to the various, whether it be anyone connected to the county offices, the auditors, treasurers, register fees, DOEs, and of course you folks. And are you ready to move through this slideshow?
We're getting close.
I can put my password
Okay.
correctly. Hold on.
Very secure.
We only have 35 more passwords to get through.
Pardon me, I didn't catch that.
I said we only have 35 more passwords to get through.
And some of these slideshows they're gonna be things that, Tammy can email to you guys, or they can be printed off, whichever is easiest. But a lot of what I'm gonna go over this morning, I'm gonna go through relatively quickly, but also, I want you to have these in front of you to use, so that when you guys need to explain how property taxes work to someone else, that at least you have a reference point to go back to look at visually, or you can reach out to Tammy or Jeff or myself, because I'm sure you guys get asked a lot of questions that it's hard to answer especially when you're, being asked that question kind of on the spot by your voters or your constituents. How's that PowerPoint coming along?
Not.
Robin, she had to go grab her phone to get the code,
Okay.
so give her a couple seconds.
Well, I'm just gonna start talking, and like I said, as it comes closer and she's ready, you can go through, but we'll make sure you guys have this in your hands later on. So basically, the reason that we have property taxes is it is a revenue source to the local government within your county. It is to provide revenue to your city, to your county, to your schools, and your townships. The state of South Dakota does not collect or spend any of those property tax dollars, but rather we are funded through sales tax. and all of the property tax dollars are collected locally. In South Dakota, we are what is called an ad valorem state. So all property taxes are based on the value of the property. So basically, the higher the value, the greater the value of your property, the greater the value, or the greater your property taxes are going to be. Also, within this slide, so there's some definitions on what assessed value is, the taxable value, the equalization or, taxable factor is in the definitions, the levy, the budget, just some terms that are gonna be used, and questions that are asked of you, so that they all make sense to you and what they are. Tammy, basically, she talked quite a little bit about what it is an assessment, and assessment notices go out in March, and that is what a person can appeal if they do not believe their property is valued at that amount. There is an appeals process, and we'll talk more about that as we move forward in the slideshow. But basically, your assessment is what your property is valued at on November 1 of every year. And it reflects the full and true market value of that property.
Robin,
Go ahead.
I've got your slideshow up now.
Okay, so if you want to scroll to about slide 6, it says, need equals valuation times the levy. And that is where I am at in talking.
We're there.
So basically, the need, that is the budget, that's your budget, that's the school budget, the city, fire district, township. The need is the total amount of money that is needed to fund each of these taxing entities. And Tammy's value of each property is multiplied by the levy to meet your budget, or all of the budgets within all of the taxing entities within the county. And I'm gonna go on, if you wanna go to the next slide, this is basically the exact same thing, but we take your budget, we divide it by the value, the assessed value that Tammy has given to your county, and that is the tax rate, that's the levy. So when your auditor's office is establishing the levy, I mean, we say that the auditor determines the levy, but basically all she does is a calculation of your budget divided by the assessed value to get that levy, that tax rate. A mill levy, a tax rate, and a levy are all the same thing. And we'll go on to the next slide. When property taxes are, the request is in limitations, there are limitations for each entity. Schools limitations are a little bit different, and we're not gonna talk about that today, but more so we're gonna talk about your limitations, the city, the county, the townships, and so forth. Their limitations are based on an index factor, CPI, that's the Consumer Price Index. Your increases in budget are limited to CPI, whatever that actually is, with a limit of 3%. So the year that it was a little over 8%, you guys still were only able to take a 3% increase. And then it's also limited by new construction. And this year, legislatively, there was a limitation put in place that is 3%. Now, that is not going to affect you folks. Most likely at the county level, There are some townships that were affected and a few, counties, but they're the bigger counties, your, Pennington, Minnehaha, and so forth. So we'll go on to the next slide, which again, references your request. The budget is divided by the value to get the tax rate. And I put this slide in there basically so you can see it as actual numbers. If you wanted to look at, what your budget is, if you take that dollar amount and you're gonna divide it by countywide value, and that's gonna give you the levy. And then you multiply that fraction by 1,000 to come up with the dollar value. So in this particular situation, you take, your actual assessed value and multiply that by that 6.9, which would be $6.91 to get what your taxes would be. We'll go on to the next slide. And this talks about stored CPI, that consumer price index increase. If your county does not use, that increase, if you don't need it for budget purposes, you can store it. Counties are allowed to store, fire districts are allowed, and cities are allowed to store their CPI. I do not know if Kingsbury County, if you use your CPI or if you store it, but you can only store that for 3 years, and that stored CPI falls off or goes away if you don't use it. If you would use that CPI within a year, our office stores that, and we would use your oldest CPI first, so that those 3 years you can stay there the longest. So we'll go to the next slide, please. When people ask, why are your taxes so high? It could be that your city, your school, your county has passed an opt-out. An opt-out is when those taxing entities have determined that they are not able to meet their budget needs with the existing limitations, that CPI and growth, and they opt out for an additional tax. Now, the difference here is that opt-outs have to be advertised. So the public still has some say if your county would choose to do an opt-out. Next slide. This is another example. I'm not gonna go through this word for word, but I want you to have this in your hands to use in the situation. In this particular one, the house was assessed at $150,000, and that tax in this situation would be $515. And we'll go on to the next slide. And this shows a situation where taxes would double. So in the previous slide, the city basically had asked for $50,000. And then now in this particular slide, they asked for an additional $50,000 in an opt-out. So basically those folks' taxes doubled. So typically, there's not gonna be much of an increase based on the limitations of CPI and growth to the budget, but the increase shows up more so when, there is an increase in the budget, like a big increase in your budget. Next slide. And again, what can a taxpayer do, when they receive their assessment notice? If they believe their property should not be assessed at that amount, they need to talk to the Director of Equalization Office, one, to make sure there's not an error in their assessed value. And then again, because taxes are calculated by your budget, the city, the school, the county, they can't appeal their taxes, they can only appeal the assessed value. And Tammy's role is to make sure that everyone in the county is assessed fairly so that, everyone is taxed fairly. Next slide. And then again, the appeals process is that after assessment notices go out, there's a time limitation, whether they need to, if they're in a township, they need to appeal to the county board, or to the township board. If they live within a city, they need to appeal to the city. And then if the city chooses not to make a decision, or if you have consolidated boards, then it would go on to the county, or if they don't agree with the local board decision, they can appeal to the county, and that's when you folks would, become involved. Next slide. This slide talks about, Jeff explained it a little bit, about that taxable value, and if Tammy, if her assessment falls in that 100% of full and true market value, then the factor is gonna be at 85%. And again, I put this slide in not because I wanna harp on it and go over and over on this, but I want you to have a visual to hold in your hands when you need to try to explain this to someone. And again, use Tammy or Jeff or I as a resource in explaining this. Next slide, please. And then Tammy talked a little bit about, sales in the property, or sales in the county, and how those properties are used to determine all of the assessed values within the county. So within each county office in the state, those, sales begin in the Register of Deeds office. The Register of Deeds office records those sales, and then, forwards all of those certificate of value to the Director of Equalization office. The Director of Equalization office records those sales in their records, and then also, creates a property card for all of those property sales. And then again, those go out and they're assessed. The auditor's office uses all of the Director of Equalization office assessed values to establish the levy. And then the fourth step within the office is the treasurer's office, who of course uses the auditor's levy and the Director of Equalization office's assessed values when they send out the tax bill. So basically, there's a circular, procedure that happens within each of the county offices across the state. And this map just gives you an idea of what each office does as their role within property and property taxes and assessments within the county. And next slide, please. This slide just gives you a little bit of an example of who paid in 2024 and where the money went. This gives an example, 2015 through 2024 in the dollars that were collected in agriculture, owner-occupied, commercial, utility, and assessment, and basically gives you a percentage of each of those, how much each one received, and then where that money went. On average, in South Dakota, schools get 50% of every dollar of property taxes collected. Counties, on average, get 27%. Municipalities get 17%, townships and special assessments get 2%. Now, with that said, because the county offices send out the assessment notices, they send out the tax bills for all of the taxing entities, schools, counties, municipalities, townships. Your county offices, send out the assessment notice and the tax bill. Therefore, you guys get 100% of the blame only get 27% of those dollars. But this just gives you an idea of where those dollars go and, who's getting them basically, how they're collected and who's receiving the funds. Next slide. And this basically gives just a pie graph of where the $1.7 billion in property taxes collected in 2024, where they go on average across the state. And if you had questions on, where those dollars go specific to Kingsbury County, you would go to sdcroptax.info. I'll send that link to Tammy and show you the path where you can look and get, information specific to Kingsbury County. Now, with that said, next slide is our last slide, and I'd like to open up, any questions that you might have that could be directed to myself, Tammy, or Jeff. But this is it. You guys, have just spent 4 hours, in your meeting, which has gotta be super exciting. We wanna thank you for joining us. And if you have questions, please feel free to ask. Otherwise, I'm done, Tammy. Back
Thank
on
you,
your
Robin.
plate.
We thank you so much, Robin. And we thank everybody for coming. And if you want copies of this, please give us your email and I will make sure that you get it. You want it, you guys want it? Hey, Brenda, do you want it too? If I send it to Brenda, can she pass it out to you guys then?
Yes.
All right. Thank you for coming. We appreciate it.
Any questions?
I got one.
Okay.
How do you determine valuations? Like, you gave factors, like how you average sales and stuff, but what's the equation, like, a crack that size on someone's wall in their kitchen, what's that worth? Like,
Well, it
how do you,
changes.
or is it completely subjective?
Well, it changes the condition and then that lowers the value.
Right, so
And that
what's,
goes through the Marshall Swift valuation system and that's where the value comes from.
so what's the equation for it? Like, for instance, Robin gave the equation, budget divided by value equals your mill levy. So
Well,
how
that's
do you determine a valuation, like how can a square footage on a lot be worth $37,000 in Lake Preston, yet the average lot that is sold over the last 4 years is only like 12,000? So, like, what's the equation? Like, that's what I'm asking.
Well, we interpret, if you're talking about land and house are two totally different things.
I'm talking, well, all of it's in the same thing. Like, as far as I'm concerned, like, what's the equation for it? That's what I'm asking.
It's not necessarily just an equation, we have to start with the Marshall Swift valuation service for the house. Then we take it times, you know, whatever the condition is and any other amenities, extra garages, dormers, driveways, decks, all that kind of thing. Those add on to it. Once we come up with that final market, or with that final value, we'll see where we're at market-wise. If we're close or we're right on, then that's the value. And that's when we do reappraisal. Otherwise, you're on a 10-year rotation, so the next year, depending on what the city of Lake Preston is, from where we're at value-wise to where they're at market-wise, that's where we'll make the adjustment. Does that make sense?
No.
Well, I think there was a underlying question in there. When we were looking at some of this information before, we would see properties, one would be valued at 10,000, the other one would be valued at 37,000. And we, for the life of us, couldn't tell the difference between the two, other than $27,000.
That's why I was asking, is it subjective?
Well, yes, it is subjective. It's subjective all the time, and that's where if you don't agree with what my value is, you have the right to come in and talk to us, and if we need to get you scheduled with your local board, we'll help you with that. But we'll also help you to show you where everything comes from.
Well, how did something like that get that far out of sync? Because that's just a matter of,
Okay, so in 10 years, we go up percentages. So I'll give you an example on my house.
okay,
1 year, my house went up 28%. Wasn't that great, Tracy? The 1 year we all went up 28%. Okay, my house went up 28%. And I went to the city council, and this is before I started doing this, and I said, for the love of God, why am I going up 28%? That's a lot. And one of the people in my town has a much beautiful home. He's got probably one of the nicer homes in town, and he said, you know what? 28% on your house is way different than 28% on mine. That's where the percentages come in.
Okay.
And that's year after year. And unfortunately, because we have so many parcels and there's only the two of us to go do it, we can't visit every parcel every single year or every other year. We have to rely on the market versus what the town is assessed at, valued at, you know, what the equation comes out to be. I can't remember right off the top of my head what Lake Preston was this year, but, that's how it gets to be. That it does get to be kind of an unequal issue when you start doing percentages, but we have no other option. We don't have any other way to do that.
So it's gonna become out of sync over time.
Yes,
And,
especially when we
and
go
that's the
10
purpose
years.
of doing the
Yeah.
10-year
Right,
assessment
right.
deal is to get
And
everything
so if
trued
you have
up.
somebody that asks you, are you gonna let her in? Say yes. Cause it's much better. We're not gonna look at your closets, we're not gonna look in your cupboards, we're not gonna look at your housekeeping. We are
Well,
walking through.
there was
those-
some concern about that, to be fair,
Well,
but I
there is.
can see your point, I honestly do.
But we're strictly looking at, look at your roof, oh my gosh, you've got a lot of stains on there, have you fixed your roof? No, I can't afford to fix my roof right now. Okay, we mark that down. We walk through and whoa, we have a spot that we probably should back out of, because we've done that before.
Well, spongy floor.
Yeah, very spongy. Walked through a couple of those last year that were pretty spongy.
And
All
you're
those
not
things that-
judging people, you're really just looking at
We don't
what
look
you
at
should be
names.
taking off of.
We don't look at names, we strictly look at numbers.
I'd like to back up to Brett's question. So you were asking what's our formula, how do we do it?
Yeah,
When we enter into Marshall and Swift, we go in, we enter the square footage, we enter what type of home it is, you know, how many stories, that sort of thing, the amenities. What it does is it gives us a base cost
Yep.
for that based on the effective age of it, and from there it adds to. So every other line item we put on, like garage finish, basement finish, what type of basement finish, cause they're all kind of different. You know, if we've seen any issues, that's where we grade it based on quality and condition. Like she was saying, all those get put into that Marshall and Swift program.
so do you physically count every crack that you might find in the ceiling, or?
No.
We don't count every crack, but as we're going through, we're looking around at the ceiling, we're noticing the issues with the tiles, the cracks in the walls. You know, we're kind of getting an overall feel of the home. If we can't get in the house, or we don't hear from that property owner, we have to assume average condition for its age. So,
Just average, not immaculate, just average.
just
Just
average.
average.
Okay.
Yep, and sometimes we all know the outside doesn't match the in and the inside doesn't match the out.
Okay.
So if we can't get in, we don't know that.
Right.
That's where when people call us and we say, you know, this is what we've got, and they say, oh no, the last people, they left in the winter, they didn't turn the heat, they turned the heat off, but they left the water on, we've got issues. That's when we say, can we please come look? So that way we're grading the property correctly. So from our Marshall and Swift there, it spits out a final value for us, and that gives us the replacement cost new. Then it takes off depreciation for the age and the condition, and then it gives us the value for that house as it stands that day when we're there. This is just on the reappraisal side, not the years when we're not doing reappraisal. So we look at that final value, we put it in there, and then that's when we look at market.
Yep.
And then if we need to, then it's times market adjustment.
Okay,
So,
so here's my follow-up to it.
Okay.
There's a home in Lake Preston, 1,740 square feet. The lot is valued at 37,500. I'm assuming it's a big lot, so I'm not gonna argue that. But the house is valued at $439, $439,364. I've never seen a house in Lake Preston sell for anywhere close to that. That's where I'm asking, like, what's
That's
the
really
what's the equation on how you can get that? Because
So-
again, you're going off your square footage and your
So-
amenities.
yep.
Has it got like, have you been in it? It's got like a marble floor, so it raises the price or
So
what?
here's the deal, it's been 10 years since we've done residential reappraisal in Lake Preston. We're slated to go out this summer. Because we only have, say, 15 sales in that market, that house is then grouped in with the rest of them. It might be a higher dollar home and the sales price might not meet You know, other homes might be selling at that, but that's where it's the property owner's position to come in and appeal the value, because that's where they bring up and they say, you know, these homes aren't selling like mine, because like Tammy said, we're limited, we can only
Fair.
use those percentage adjustments during those years.
So, if it, you know, it's 30 years old, so last evaluation was 20 years ago.
10 years.
10 years ago, sorry, so it had been evaluated twice essentially over the lifespan of the house.
Right.
So, in 10 years, it's gotten,
Based on the sales that have been happening and
which
the,
nothing has gone that high,
but the increase.
and it's a 1,700 square foot house, mind you.
But you're looking at it as its own individual, and in those 10 years, we have to look at all the sales in Lake Preston, and we have to adjust
again-
all those changes to that sale.
Yes,
To that
perfect,
house.
perfect, and again, nothing is sold for that much, so how did it get that far up? That's what I'm asking,
But I
where's the
think that's where your
evaluation?
percentages
What's the
come in.
equation?
But Brett, that's where your percentages come in. It's kinda like when the gentleman said to me, well, my house is 28% on your house is way different than 28% on mine, and that's true. That's true, but we don't have an option, we don't have any other outlet to go do that, because we don't have the staff to go out every other year.
That's
So-
why
so
you
your
have that appeal
percentages are
process.
off, and that just adds up,
So is
compounds
so is that-
your error over the 10 years.
Yeah.
Maybe I'm on the same page with him on the question or not, I don't know, but that original value, then if that's not coming from market, is that coming from that Marshall?
So the,
Like, how is that how it's getting so high then?
no, it's starting at Marshall and Swift for the reappraisal and the cost. Then, in between our years where we go out, then you're taking market adjustments based on the sales ratio with those overall percentages. If we notice that, like this house you're talking about, things are getting way out of whack, like,
Yeah.
you know, this one's really taking a lot of jumps and it's not meeting what the other market stuff does, or it sold for considerably less, that's an indicator to us that we maybe need to move up reappraisal in this area.
So
Or-
but you don't physically look at the book and see what you're handing out every year? Like essentially to Lake Preston, like you don't look at the house and say, wow, this one's at $479,000 for total evaluation with the land. You just hand it, and it's up to us to reevaluate and find, like, the board of evaluations at the city council, it's up to us to then determine if it's out of whack, as long as the homeowner challenges it.
That's all part of mass appraisal, and that is the hard part, but when we go back and we come out to do reappraisal, it's kinda like a reset. All of those percentages go off, then we start at the Marshall Swift, then we switch from there, Marshall Swift, less depreciation, we've got a dollar number. Now we're gonna compare it to the sales, where are we at with sales? If we get this value up here, is it going to be enough? And I can show you that if you'd like to see it.
I just want to be able to answer these questions of how it happens that it gets that far out, cause again, it's got, like, to me, if I was looking at this at a sheet of paper and it was my job, I have no idea what kind of spreadsheet you have, other than this book that we get, that we go through when we do our yearly evaluations in town. That's the only thing I have that we get. I'm assuming somebody looks at it besides us and the landowner. Now, because it's all in a folder, it's all put together. So, to me, I look at it and I see this, and there's a few houses on there that to me are just like, holy smokes. And again, I'm going off, nothing has sold for $500,000 in Lake Preston, nothing. So that, to me, it seems odd that it gets up, that it can get that far out.
Like the
Before-
percentages adjusted every year are
be-
too high.
Well, it doesn't, if you're going off the data of the sales data, and nothing is sold anywhere close to that, it seems impossible that something could get up that high. I think there should be like a checks and balances on it, that you can see, well, wait a minute, the most expensive thing that's sold in Lake Preston is $350,000, and that's a brand new house that was constructed during this crazy time that we live in now, where everything's twice as high. So, that's where I'm getting at, like, how do you determine that? And if it's just because constant percentages go up, but there's no checks and balances until the landowner comes in once every 10 years, or when it gets high, how do you then make a determination that they are assessed by, in my opinion, well over $100,000 too high? But again, this isn't dealing with taxes, this is dealing with assessment.
Right.
Sometimes when you're dealing with sales and mass appraisal, you're using a lot of statistical analysis. It all starts based on actual data. So differences between houses, 1,700 square foot, different from 1,500 square foot, differs from 2,500 square foot. If I build a house for $500,000, but nothing else has sold for $500,000, does that mean my house isn't worth $500,000?
Your house is what you said goes through sales data, so it's whatever somebody will pay for it. So if you built a $500,000 house, you sell it for 200,000, based on a good sale market, the house is worth 200,000.
It would be if it was an open market. Would you sell your $500,000 house for 200,000?
If that's what you put into it, and you had to get rid of it, and you put it on the open market, then that's what the value is. The
I'm
value is
saying
what
because
somebody
we
pays for.
start, because they start with the cost.
Right,
So if it costs $500,000 to build this house,
okay,
would you sell it for 200?
I didn't build it for $500,000. If somebody else did, and they sold
This
it,
is theory, theory.
yeah, this
You know,
is
I'm just
fair.
saying.
Right.
Just because there's not typically a sale that happens at that amount, doesn't mean the house isn't worth that much. Because it might be twice the square footage, twice the size, twice the amenities, higher end materials into that construction than everything else in town
Sure,
that's selling for 250.
right,
If I put twice as much into this house, just because nothing sold at that amount, does it not mean that's where the cost comes in? If there's no market for that property specifically, they rely more heavily on the cost method. What it would cost to build and reproduce that property.
so
That's
if
where
it's,
you get
so if
into
it's been
those
built and never
different-
sold, if it's been built and never sold, the same owners that built it, they built it 30 years ago, so if it's never been sold, you have to go off replacement value.
You're gonna rely more on the cost. Yep.
Rather
replacement
than,
cost,
rather than
less
similar
depreciation.
homes at similar sizes
Well, you're.
around the community, you're gonna go more off what replacement cost would be versus data of similar homes and similar houses that have sold for. That's what you're saying, correct?
All of them would. You always start with that cost basis in the mass appraisal. So you're always looking at what it would cost to replace. And then you adjust those numbers to the market depending on the year.
Right, so until it sells, it's,
So you-
it's worth replacement cost, not
No.
what other, you can't use the data from, but what I'm saying with what I'm hearing is you're saying that the replacement cost holds more value to a house that has not been on an open market.
Correct.
Okay.
But year to year, you know, with inflation, the cost to build that property increases.
Yep.
So in one year, it might have cost you $500,000 to build that. That's your cost base, that's your starting value. The next year, if you go in and you talk to the lumber companies and you talk to the contractors, I can't build that for 500 anymore. It's gonna cost me 550,000 to build that.
Yep.
In,
That's your next year's value, because that's what it would cost to replace that. It all trends with market and different cost, production, numbers. Those are where those numbers come.
what you're saying, to a point, makes sense, as long as there are lots available. You see, if there's a lot available that's similar to this house, and I'm just speaking because I'm learning like you. But if somebody comes in and trying to decide whether they're gonna pay $500,000 for that house, or am I gonna buy that lot and build that same house, what's that gonna cost me? If that's gonna be 400,000, then it would make more sense to build the house than to buy the house. If it's gonna cost me 600,000 to buy the lot and build the house, then I'm better off buying your $500,000 house. I mean, ultimately, that is what drives up the value of all the homes in a community, is the price of a new home. I mean,
Correct.
because
I
they're always.
love that you said that, because that's basically what you said was describing the principle of substitution. I'm not gonna spend $500,000 on a property I could build for 400. That's a basic principle of appraisal practice.
And it kind of makes sense, but I mean, we've seen in housing crisis, like in 2008, 2007, 8, 9, whatever, a lot of these houses were valued at maybe 1/3 of what they're valued at now. Was that realistic? At that point, you could buy any of the houses on the block a lot cheaper than you could build a new house. In the meantime, that changed, and then COVID kind of flipped the equation again, and all of a sudden it became a lot more expensive to build than to buy. So I can understand how in 10 years, things can get terribly unbalanced. But this 10-year, this is your cycle where you're gonna look at everything
Yeah,
in
2005, 15, and 25.
in Lake Preston. So everything gets kind of the same basis
Gonna get
this year,
trued
is
up.
that correct? What's that?
I say it's gonna get trued up.
Yeah, I mean, that's kind of the way I look at
I
it.
look at it anyway, I probably could be wrong, but
You'll have to
The thing is, it'll be true to then.
yes.
It'll be true to now.
Everything gets,
5 years from now,
everybody's starting off fresh.
yeah.
Then we screwed up for 10 years.
I think one of the other topics they were discussing was the land, so.
The land is assessed by the front foot, not by the square foot, it's the front foot,
Right,
or where
so
the front door sits.
a lot that
Okay.
could probably sell into Smith for probably 25 or 30,000 is never going to sell in Lake Preston for that,
I don't agree with that.
because they're typically,
Okay.
they're typically 10. And I think the most I've seen, just a lot, was 12, but.
I don't totally agree with that. I agree with it to a point, but I don't totally agree with that. We do have where this will also tell us when we go to do the reappraisal of the houses, it will tell us, okay, this is how much of this sale is house, how much of this now is land, what's left is land. Then we know if we need to raise you or lower you. That's the process. It's not a perfect process, it's not a wonderful process, but it's the process that we have. So,
Well, and I think we also had discussed, DeSmit has a lot of more amenities than there's a hospital, 2 clinics, a dentist. The difference between us and DeSmit is pretty extreme.
but we still have to go by the sales. Market
Yeah,
value.
that's where,
The
that's where we were
sales
bringing
in
up the
Preston.
averages, and that's where the averages, the math wasn't mathing.
Well, I don't know what to tell
We
you.
factor that in though, because we look at Lake Preston as their own market. We don't lump DeSmit sales in with Lake
I think
Preston
that
or
was a question,
Arlington
and
sales.
thanks for addressing that.
Yeah, we don't lump it all in, we look at Lake Preston as a
Oh,
whole.
we were lumping everything
whole
together
county.
to try and find out where these numbers were coming from. And
Yeah.
that's how that's why we were saying, the math wasn't mathing. So if Lake Preston's on its own, then the math really isn't mathing. Then it's even farther out of balance.
The land part is throughout the whole county though, right? You did the front foot
Yep,
thing.
throughout the whole county, yep.
Along Highway 14.
Right, just on Highway 14, we haven't done the small ones yet, we're doing that this summer.
It sounds like everybody's in violent agreement, it's time to do a citywide assessment.
Oh,
I
yeah,
think
it
so.
is.
I
It
think
always
so.
gets that way, by the time we hit that 10-year mark, it almost feels like we're 3 years behind.
Yeah.
But unfortunately, we only have, just like I said, just Maggie and I, and we have 8,200 plus parcels, so that makes it a lot more different. So,
Stephanie, I don't wanna put you on the spot, but did you notice a difference from last year to this year?
Yes.
In people's with the value and everything?
So when you reappraise them, like our house will be reappraised, and will you ever reappraise it lower than what's assessed value for is
Yeah,
right now?
we have had that, yes.
Most of Arlington was.
Yeah, cause you take off we start back down at the base, we take off all of those increases, okay? And we go off that, and then we take that information off the Marshall Swift, and Jennifer, if you wanna come upstairs, we can show that to you. on
No,
that
I'm
card.
just asking if somebody
Yeah.
else, but
Yeah.
I'm paying out, my house was assessed outrageously, but I'm just have to pay it because it's not within 10 years to bring it back down.
But this summer, could,
Well, that's what I,
yeah, and we'll know more well, by
Okay.
March.
Can, you're on a 10-year cycle, but if somebody feels like they've gotten way out of whack at year, halfway through the cycle, I know they can go through the process of arguing what their valuation is. Can they actually ask for a reappraisal in the middle of the cycle, or?
They can, but we have to be very careful with that, that's a slippery slope, because then you're changing, I changed one in Arlington, and I only changed one in Arlington, and I haven't reappraised everybody, that's a slippery slope.
Then you get more out of whack with all
Right.
your
Right, well, and it's not,
percentages.
well, then it's not fair and equal from all landowners.
That, I understand.
Okay.
But those are the ones that they should be bringing to the city or the county.
Right.
If you feel it's really whacked out,
Yeah.
then come to
I mean,
the
that is why the
council
process,
and-
that is why that process
Right,
exists.
yes, right.
There's a reason it's there.
And it's a good process, it does work, and usually, as long as I see that the boards are comparing properties, I will let what the city does stand. If somebody's just sitting there and going, oh my God, she's just totally whacked, this is only worth $250,000, and everybody on the board goes, yeah, that sounds about right, that person will come to the county board, because they haven't done their due diligence as a board. So, I haven't had to do that too many times over the years.
Well, thank you for putting this together,
Thank you.
and thank you all
Greatly appreciate it.
for
Thank you
attending.
for coming, I really appreciate
And
that.
let Tammy go to work.
Yeah. So if you guys wanna give me, if you want the information that was presented today, can you write your, email address on here for me, or if you want me to mail it? I'm just gonna send it to you.
Yep, I'll just send it to
I'll
you
send it
again.
to, I will send it to the cities.
And then I'll,
Yes. Thank you.
and I'll forward it tomorrow.
That sounds good. All right. Now you can take apart your camera.